Hi everyone, welcome back to Corporate Decoder, the place where we read corporate reports so you don't have to. Today we're diving into the latest quarterly filing from NexPoint Residential Trust, or NXRT. This report is a bit like a messy apartment after a wild party, lots of details, some good, some not so good, and definitely some surprises hiding under the rug. Let's see if we can make sense of it. We'll start with the big picture. NXRT, a company that owns a bunch of apartment buildings, mostly in the southeast and southwest, just released their financial report for the first 3 months of 2025. The hook, a net income took a serious dive, but is it really as bad as it looks? Let's find out. First things first, a word of caution. These reports always have a forward-looking statements section, which is basically a disclaimer. They're saying, hey, heads up, we're making educated guesses about the future, but things could change. They mention a whole bunch of risks, from the economy tanking to competition getting fierce. Keep that in mind as we go through these numbers. Things might look different in a few months. All right, let's jump into the numbers. The balance sheet is like a snapshot of what the company owns and owes. We can see their total assets were about $1.8 billion. But hold on, there's also a line for accumulated depreciation, which is over $532 million. That's how much their buildings have supposedly lost in value over time, at least on paper. This highlights a fundamental challenge in real estate investing. Things wear down, even if the market value goes up. Now let's check out the income statement. This tells us how much money came in and went out. Rental income was $61.4 million, down from $65.6 million the previous year. That's $4 million less in revenue. That's not great, as a decrease usually signifies issues filling vacancies, rent decreases, or bad debt. Property operating expenses were also down a bit, about $1.3 million. They managed to cut costs down to $12.5 million, but those changes don't necessarily mean the company improved their output, as they might just cut costs and services to save money, which means potentially less happy clients and potential losses in recurring revenue. Here's the big one. Operating income, that is profit from business before other gains or losses, took a big hit. This quarter, they're reporting $7.4 million compared to $40.9 million decrease. However, if you look at the statement, it's because last year they had a very large gain on sales of real estate of $33.5 million decrease. However, if you look at the statement, it's because last year they had a very large gain on sales of real estate of $33.5 million decrease. However, if you look at the statement, it's because last year they had a very large gain on sales of real estate of $19.7 million decrease. However, if you look at the statement, it's because last year they had a very large gain on sales of real estate of $31.5 million decrease. However, if you look at the statement, it's because last year they had a very large gain on sales of real estate of $31.7 million decrease. However, if you look at the statement, it's because last year they had a very large gain on sales of real estate of $31.7 million. Interest expense, how much they're paying on their loans, stayed roughly the same, around $30 million. So the debt burden hasn't changed. This might become a problem with the current interest rates. And here's the final verdict, a net loss of $6 million compared to a net income of $26.4 million last year. Now, what can we tell just from those numbers? They mention weighted average shares outstanding of about 25 million and diluted shares of 26 million. Keep that number in mind because it's the denominator for the EPS calculation. Drilling down, earnings per share were negative 0.27 against a positive 1.02 previous year. This means for every share, the company basically lost 27 cents, a sharp contrast to the profit of $1.02 per share. Switching gears to cash flow, let's look at where the money's actually moving. Starting from net income loss already discussed, one line that stands out is that depreciation and amortization costs remain high, around $24 million, which, while a non-cash expense, tells us about the rate that their equipment is being reduced in value. However, we also see that net proceeds from sales of real estate is much lower as well, because there were less, going from $102 million to nothing. This is important to note. Diving deeper, cash flow used for mortgage payments decreased a ton, as well as credit facilities payments decreased $24 million. These types of changes can signify lots of things, including better management of debt, but could also mean refinancing into worse debt schedules. We need to dig deeper to understand. Taking it all together, net increase in cash increased, meaning there is more cash on hand than previously, increasing from $49 to $23.4 million. Now let's see what the company has to say about all this in the notes. We can see in the organization description that they own 99.9% of the properties. NexPoint Real Estate Advisors manages all operations and investments, which could lead to potential conflicts of interest, something to keep in mind. They also discuss disaggregation of income statement expenses, which is really a fancy way of saying they'll have to break down their expenses in more detail in the future. The company sold one property during the 3 months ended March 31, 2024. They say who they sold to and what was made, all normal details. Now, about that debt they're carrying, around $1.55 billion in mortgages. The weighted average interest rate is 540%, which is high, but they have some tools to mitigate it, as we will see in the derivatives section. Now, a lot of their debt is tied to floating interest rates, which means it can go up or down depending on the market. To protect themselves from rising rates, they use financial instruments called derivatives, specifically interest rate swaps and caps. Basically, they're betting against interest rates going too high. It's risky, but if rates do go up, these instruments can save them a lot of money. This table describes their interest rate swaps, where they're locked into paying a fixed rate no matter what happens with floating rates. They also have interest rate caps, which are like insurance policies against rates going above a certain level. They have an average fixed percentage of over 7%, which is pretty good. These guys know how to handle their money. Moving on, let's look at stockholder equity, which has more vanilla information. What do we learn? They issued some stock, 167,273 shares related to compensation, which is normal. They did declare a dividend of 0.51 cent per share. That is usually very good news. They repurchased approximately $7.6 million, especially at 34.29. Shows they have faith in what they do, and it's trading well below their expectations. The end, and of course here is the moment we have all been waiting for. It is the section where they say there are no defaults. The story here is a company facing a challenging macroeconomic market with big losses, but thanks to instruments and past deals, they managed to stay afloat and even retain positive cash flow. It will be interesting to see how they do next year, but for now it seems very promising. They still highlight the need to be flexible, manage costs, and make smart investments. One of the interesting elements is their careful management of their debt, which might become a liability given the current environment seems steady. However, in these filings, like most corporate reports, the company tries to paint the prettiest picture and give you some good news to balance the bad ones. One rule, NXRT is trading on a very difficult environment, but seems to be pretty prepared for it. If you guys enjoyed that summary, make sure to leave a thumbs up and hit subscribe to get more information like this. Also, make sure to comment on what stocks and investments you want to learn more about. See you all next time.